Well, moving on from one strategy note to another, let's focus in on BNP Paribas' view. They believe that the Nifty FY23 consensus EPS is lowered by about 4%. They're expecting overall earnings growth of about 12.6%, with some concerns like commodity price rises. Kunal Vora is the head of equity research at BNP Paribas, now joining in on the show. Kunal, thanks so much for taking time out. So how much of an actual concern do you see the commodity price rise and employee costs hurting gross margins of companies across the board? And will it be just for this quarter, or do you believe that it's likely to expand into the coming quarters as well?
Sure. Thanks for having me on the show. Our view is that commodity cost is not really the biggest concern right now. We've seen commodities actually benefiting the earnings in FY22 and FY23. We've already seen some cuts because of pressure on margins. Second half FY23, we could start seeing actually commodities helping many of the Indian consumer companies. In case of IT also, we believe that the margins are close to their bottom right now, and things could actually start improving there also. Our concern, the reason why we are negative on the market is a few things I'll point out. First is obviously valuations at about 19.2 times 1 year forward. We are close to 20% above our peak. In case of our valuation premium over Asian peers, we are almost at a 60% premium. And we've rarely seen this kind of premium really getting maintained. Also, when it comes to the bond yield, which are at 7.2% versus earnings yield, which is 5.2%, there's a 200 bips gap. And this is almost the peak gap which we've seen. And whenever you see in this level of gap, the 1 year forward returns have actually been negative. We've seen that playing out in 2010, 2014, 2018, and we wouldn't be surprised if that really plays out again from here. So our view is that investors need to be cautious in the market. Also, not to forget the global risks. Our economists believe that global growth is likely to slow down, inflation is likely to remain elevated, and they advise that the credit assets should be avoided. Yeah, that's our view.
Kunal, I'm also intrigued by your overweight stance on IT because there are growing murmurs and concerns how growth is likely to slow down in FY24. Street is not worried about FY23, but in 24, growth is going to be a challenge and margins have been under pressure. What's your thesis there?
Yeah, so in case of IT, our view is that demand is not really going to fall off the cliff. You could have a couple of quarters in which the demand could be weaker. Having said that, post-COVID, we have seen structural tailwinds for this industry. This is an industry which has got some of the best management, some of the strongest balance sheets, and they've been returning cash to the shareholders. Valuations are at a slight premium compared to history, maybe about 22 times compared to historically 18, 19 times. Having said that, we believe that that premium is actually justified considering the kind of strong tailwinds this sector has. There is also a strong possibility of Indian companies continue to gain market share over the next few years. Indian IT companies still have about $200 billion of revenue compared to about 1 trillion market size. And the market share gains for Indian IT companies could continue, though it might take a little bit of a slowdown in case of the near-term outlook.
So you believe that right now, in terms of the market approach, one should focus on defensive positioning. So would that be, an overweight stance on IT and pharma? Anything specifically within that space?
I wouldn't comment on specific stocks, but when we are talking about being defensive, we are talking about defensive in terms of valuation. Traditional defensives such as consumer staples, consumer durables, many of these sectors which are domestic facing are actually trading at fairly elevated valuations. So we are not recommending those stocks. What we are recommending is wherever we see a good comfort compared to the historical valuations. And over there, the private banks fit in, which is the sector which is trading at close to its historical average valuation. IT services, some premium, but good growth potential. Pharma as well, we believe that the companies which have a good exposure to India as well as companies which are into the diagnostics as well as the hospital space, they look good. We also like the telecom space, in which we believe that we are looking at two players really dominating the space for next many years. And it's an industry which has got strong digital tailwinds.
What about autos? Do you think the best of the rally is behind us? Is that the reason that you are turning a tad bit cautious on that one?
That's right. So what we believe is that we've seen a K-shaped recovery. We like the PV space, the CV space, in which the companies are well poised. Many of these companies are also fitting into our affluent India theme, which we've been writing about. We don't really see that kind of a growth potential in case of two-wheelers. So two-wheelers are looking reasonable in terms of valuations, but we don't like the growth potential. In case of four-wheelers, we see a fairly strong FY24. But after the big rally which we've seen over the last few months, we believe that we should be waiting for better entry points.
Okay, better entry points is something that you need to wait for when it comes to the entire, auto space. But Kunal, one thing that has been working out for investors this year is the capex recovery. A lot of corporates are investing big time in increasing their capacity. We have seen industrials order book go up, and even the likes of defense and other ancillaries are seeing quite a bit of traction. Is this a space which can generate alpha over the next 12 to 18 months?
I agree. Capex scheme actually looks good. What we've seen is government has made many structural changes. So over the last few years, PLI's scheme has been introduced. Even the allocations to Capex have been very high from the government point of view. Many of these defense companies could benefit from the Atmanirbhar initiative which the government has taken. Having said that, we'll need to be selective here. It will really depend stock to stock. I wouldn't say that broad brush everything looks good here. Utilization levels have gone up. Corporate balance sheets are looking pretty healthy compared to what we've seen in the past. So yes, it's a theme which is likely to play out over the next few quarters. Having said that, I wouldn't say that everything is looking good there.
And then, if most of these sectors are actually looking good to you, Kunal, what's the space which is a clear avoid at the moment?
So what we would avoid is everything which is very high in terms of valuations. There are many of the businesses which were trading at 25 times 10-year back, and they were growing at a much faster pace. Today, the same businesses are trading at 40, 50 times with lower growth rate. And the problem has been that in many of the sectors, we see the same trend, that the growth rates over the last decade have actually um, moderated while the valuations have actually expanded. So we would avoid sectors in which the valuations are elevated. Similarly, the new businesses which have got listed, many of them are pricing in the growth for next decade. So we would avoid any such businesses.
Okay, thanks very much for giving us a clear picture as to what makes it to the list, what we should avoid, and your outlook on the earnings and market momentum.